gives me immense pleasure to welcome you to our research webinar featuring our initiation coverage of TYRE PLC and third quarter financial year 2022 performance of ACL Cables PLC. We are pleased to inform you that Capital Trust Securities was ranked number 1 for the calendar year 2021 in terms of transaction turnover, brokerage turnover, and number of transactions. Capital Trust Securities is also ranked number 1 for the financial year 2021-2022 so far in terms of transaction turnover, brokerage turnover, and number of transactions. Today's webinar is the 28th of a continuous series of webinars. Capital Trust Research Private Limited has been at the forefront in correctly identifying early and recommending stocks through its webinars and comprehensive research reports. Even during pandemic conditions, the stocks recommended by Capital Trust Research through its webinars and research reports have generated over 580% total return from 1st January 2021 alone, if both proportionated to their market caps. We are very happy to reiterate that we have guided our clients to buy and continuously follow the stocks we have recommended, thereby generating enormous total returns for them while contributing towards a fundamentally driven continuous rally in the Colombo Stock Exchange. With the objective of broad-basing our research coverage and identifying undervalued stocks for our investors, Capital Trust Research continues to seek value in the Colombo Stock Exchange by carrying out comprehensive fundamental analysis on selected companies. Therefore, 3 weeks ago, we initiated our research coverage on Sunshine Holdings PLC, and today we are initiating our research coverage on Kalani Tyres PLC. Now, we are pleased to introduce Mr. Hasita Liyanage, Head of Research of Capital Trust Research Private Limited, and Mrs. Divya Kasichetty, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentations. Over to you, Divya.
Thanks, Prashani. As you are aware, ACL Cables manufactures electric cables, switches, and accessories, and holds approximately 70% of the dealer market share and 75% market share of the institutional market. The group's product range includes power cables and conductors, armored cables, aerial bundle cables, control cables, telephone cables, and auto cables. ACL owns 79.3% of Kalani Cables, who are involved in the manufacturing and selling of power cables, telecommunication cables, and enameled winding wires. ACL also owns approximately 65% of ACL Plastics, who is involved in the manufacturing of plastics and PVC compounds. Let's have a look at the key growth catalysts for the sector. The local cable manufacturers, including ACL, are beneficiaries of the import restrictions. Previously, among state-owned institutions, CEB was allowed to import cables at duty-free pricing. Further, certain foreign projects registered with the BOI were granted permission to import cables when the required type was not available in Sri Lanka. ACL supplied 80% of the requirements of duty-free projects owned by overseas investors and approved by the Board of Investment. In FY18, the industry saw a tendency towards relaxation of the negative list for some free trade agreements. However, since then, the industry lobbied the government to keep cables in the negative list, even for free trade agreements, and has succeeded. At present, cables remain on the BOI negative list, providing an opportunity to the local manufacturers to supply the product for these projects. Revival of the construction and real estate industry will also support cables industry growth and drive revenue growth in the second half of financial year 22. The Budget Proposal 2022 emphasized the importance of providing 70% of the aggregate electricity demand through renewable energy by 2030 and proposed to expedite these investments. Approximately 2,000 megawatts via wind and solar power plants are expected to be added to the national grid within the next 3 years with the support of the private sector. The Sustainable Energy Authority has identified locations island-wide for over 1,008 megawatts of wind power, 1,010 megawatts of ground-mounted solar, and 1,695 megawatts of floating solar. As these projects are expected to be prioritized and developed over the next few years, the cables industry will benefit from enhanced new revenue streams in the short to medium term. We expect a surge in demand for electrical cabling from the plant developers, as well as from the CEB, for the setting up of new transmission lines for grid connectivity. Having discussed the key growth catalysts for the industry, let's discuss how the ACL Group, given its dominant presence, is well placed to be a prime beneficiary of these. As mentioned previously, ACL controls the market with over 70 to 75% market share across various segments. This enables the group to drive price increases as and when the need arises and ensure that their margins are maintained. ACL carried out price increases on 5 occasions from November 2020 to 1st October 2021, which amounted to a 50% increase in prices. ACL acquired and modernized Kamal Cables machinery, which commenced operation in the third quarter of financial year 22. The additional capacity is expected to further support expansion within the dealer market capacity by 50%. The local cable market size is approximately 29 billion rupees. Industry consolidation has been witnessed during the last few years, and currently the key players within the sector are ACL, subsidiary Kalani, Sierra, and Orange. Of the total market, approximately 52% is the dealer market, 28% caters to the private companies, and 21% to the government sector, which mainly includes Ceylon Electricity Board. Let's have a look at the dealer market. Within this space, ACL holds approximately 70% market share, where they operate through 7,000 dealers island-wide. The other players operating within this segment include Sierra Cables, Orange, Sun Cables, SR, and Ruhuno. The dealer market does not rely on imported products. Therefore, ACL Group is not expected to be adversely impacted in the unlikely event of the current import restrictions on cables being lifted. In fact, the strict import controls implemented has positively impacted the local manufacturers as smuggled cables are not available. Moving on to the institutional market, the group holds approximately 75% market share. Sierra Cables and Orange also operate within this segment. ACL Group serves key government institutions, including CEB, Lanka Electricity Company, Railways, and Sri Lanka Telecom. Imported raw materials such as copper, aluminium, and PVC amount to majority of ACL's cost of sales. Copper prices grew 35% year-on-year and 3.4% quarter-on-quarter on average in the third quarter of financial year 22. This was mainly driven by higher demand from leading consumers, China, given the economic recovery post-vaccine rollout. When looking at the average prices, a month-on-month decline of 1.8% was witnessed in December 2021. Benchmark copper on the London Metal Exchange on the 28th of January 2022 declined 4.5% week on week and was recorded at $9,508 per ton. This was the biggest weekly decline since October 2021, as the prospect of Fed tightening the rates reduced investor appetite for risky assets and boosted the dollar. Price weakness is expected to last through the Chinese New Year, which is typically a time of low demand. However, longer-term outlook remains positive, with copper prices expected to remain elevated, with a global transition from fossil fuels to copper-intensive electrification likely to boost demand. Copper prices, although elevated, are expected to decline this year, weighed down by weaker demand as rising interest rates curb economic growth while mines churn out more supply. Aluminium prices rose 43.6% year-on-year and 4.2% quarter-on-quarter on average in the third quarter of financial year 22. The price of aluminium continued to appreciate in December 2021 by 2.2% month-on-month. LME aluminium was 1% week-on-week. This was its fourth consecutive weekly gain and close to October's 13-year high of $3,229. The price increase is largely owing to the supply-side concerns given the production curtailments in China and Europe because of the power issues. Supply-side concerns prevail with high power prices, forcing some smelters to cut production, and a Russia-Ukraine conflict could interrupt exports from Russia, a major producer of aluminium. Therefore, aluminium prices are forecasted to rise during the year, led by high demand from the automotive industry, increased prices of energy resources, and a supply shortage arising from China's diminishing production to decrease CO2 emissions. ACL imports majority of the raw materials as availability of scrap metal is limited, and there is a ban on importing scrap unless for export purposes. The company does not book contracts in advance and therefore is largely dependent on prevailing prices. It must be noted that given the group's dominant market share of 70 to 75%, an increase in costs can be passed on to the end consumers successfully. In the event of a decline in copper prices, a positive impact on margins will be witnessed, as it is unlikely that the company will immediately pass on this benefit to the end consumer. The company holds sufficient raw materials for the short term, approximately 2 to 3 months. Its strong financial position, including US dollar reserves and export proceeds, are expected to be utilized to mitigate an adverse impact from importing raw materials. Considering the higher average selling prices implemented in October 2021, along with the higher demand experience in the construction material space in the second half of the financial year, we have revised our forecasts. The enhanced capacity brought about from third quarter financial year 22, considering the acquisition and modernization of Kamal Cable's machinery, has also been considered. Accordingly, revenue is expected to be recorded at 13.8 billion rupees in the third quarter of financial year 22. The growth is primarily stemming from the enhanced capacity in the dealer market, higher demand, and increased average selling prices. In terms of revenue composition, approximately 85.5% is forecasted to be generated from local revenue. The local revenue is forecasted to steadily grow, led by strong volume growth in the dealer market and project market segments, coupled with higher average selling prices. In line with its strategy to focus on the electrical segment, switches, including its low voltage switch series, miniature circuit breakers, range recorded a significant growth year-on-year. Exports are forecasted at 14.5% of total revenue. ACL is expected to benefit through synergies from Cable Solutions Private Limited, which was acquired in November 2019. The group expects to use its marketing strength to capture untapped export markets, including Europe and USA. The group company, Kalani, has carved a niche for itself in the export market and supplies to India, Maldives, and Bangladesh. Further, enamel winding wires are also exported indirectly to European transformer manufacturers through export processing zones in Sri Lanka. The export segment is currently battling the challenge of higher freight rates to selected markets. However, Efforts are underway to expand its reach to new markets, including Malaysia and Indonesia, with niche products, in addition to its key export markets, Bangladesh and Maldives. Moving on to the margins, the GP margin is conservatively estimated at 20.1% and operating margins estimated at 15.1% for the third quarter of financial year 22. Profit attributable to equity holders for the quarter is forecasted at 1.36 billion rupees. Looking at the full year, we forecast a revenue of 43.4 billion rupees, a growth of 92% year on year, with profit attributable to equity holders forecasted at 3.87 billion rupees. Moving on to the financial forecast of financial year 23, we expect the cyclical nature to continue, with the second half being stronger than the first half due to the higher demand in construction materials during that period. For financial year 23, revenue is projected at 47.73 billion rupees, representing a year-on-year growth of 9.9%. GPMs have been conservatively forecasted to be lower than financial year 22 at 19.1%, considering the expected rupee depreciation. Operating margins are forecasted at 13.93%, with profit attributable to equity holders forecasted at 4.29 billion rupees, which represents a growth of 10.76%. We expect profit contribution proportions from the subsidiaries to largely remain in line with the second quarter performance. In addition to the above, profits are supported through a steady contribution from renewable energy sector associate company, RESUS. Share of profit from ACL's 32.53% holding in RESUS Energy grew at 14.44% CAGR in financial year 16 through to 21 to 107.43 million rupees. The company has a portfolio of 14.5 megawatts of hydropower and 2 megawatts of solar power. Having discussed the financial forecasts in detail, let's review the trading multiples. ACL trades at an attractive PE of 7.55 times on financial year 22 forecasted earnings and 6.82 times on financial year 23 forecasted earnings. The PBV is at 1.87 times on financial year 22 and at 1.58 times on financial year 23 forecasted earnings. Considering an expected dividend payout in line with previous years of 35.29%, dividend yields are forecasted at 4.67% in financial year 22 and 5.18% in financial year 23. ACL's growth story is backed by its market-leading position and established track record of catering to large-scale projects, including CEB projects and majority of the high-rise residential apartments in Colombo. Furthermore, timely in-house capacity additions and inorganic growth, including recent acquisitions, is also expected to strengthen earnings. Recent acquisition and modernization of Kamal Cable's machinery will drive capacity increase and further strengthen position in the dealer market. Strong volume growth with a steady order book and multiple average selling price increases implemented from November 2020 to October 2021, resulting in a price increase of 50%, is also expected to boost earnings in financial year 22 and 23. The current regulatory environment, where imports of cables are restricted, also impacts ACL favorably. As mentioned previously, the recurring net earnings is forecasted to grow at 225.87% year-on-year to 3.87 billion rupees in financial year 22 and 10.76% year-on-year to 4.29 billion rupees in financial year 23. ACL is currently undervalued and is trading at a PE of 7.55 times on FY22 forecasted earnings and 6.82 times on FY23 forecasted earnings respectively, and trading at a PBV of 1.58 times FY23 forecasted earnings. The group announced a 2-for-1 share subdivision, which came into effect in February 2021 and improved the liquidity of the counter. We believe that this counter should trade at a PE ratio of 11 times on FY23 forecasted earnings. This has been arrived at considering its over 70% market share and other peers within the building materials sector. The assigned PE ratio is at a discount of 22.7% to the broader market PE ratio of 14.23 times and Sierra Cable's PE ratio of 17.35 times. Considering our revised financial forecasts, we assign a fair value of 197 rupees, which provides a 61.48% upside on this counter. Now, let's move on to TYRE. Let me start by giving an overview of the group structure. Kalani Tyres is the holding company of the group. TYRE is the former Sri Lanka Tyre Corporation, which was the sole tyre supplier to the country under the Kalani brand prior to privatization. Post-1990, TYRE's market share was approximately 70%, with imports taking up 30% of the market. However, with the gradual reduction of import duties post-privatization, TYRE's market share declined to approximately 45% during the pre-pandemic period. The fully owned subsidiary of the company, Executive Cars Private Limited, commenced its principal activity of vehicle hiring on the 1st January 2006. CEAT Kalani Holdings is a 50-50 joint venture with renowned Indian brand CEAT and is now the largest tyre manufacturer in Sri Lanka. In June 1999, the company transferred its tyre manufacturing assets to CEAT Kalani Holdings Private Limited and has since been operational for over 30 years. The manufacturing facilities are located in Kalaniya and Kalutara. CEAT Kalani Holdings, in turn, owns 100% of associated CEAT Private Limited, CEAT Kalani International Tyres Private Limited, and CEAT Kalani Radials Private Limited. A new company, Asian Tyres Private Limited, was formed as a fully owned subsidiary of CEAT Kalani International Tyres Private Limited to manufacture radial tyres. As TYRE, company-level financial contribution is insignificant. Our presentation will largely focus on the operations and performance of the JV, CEAT Kalani Holdings Private Limited, as this is the key contributor to the group. As mentioned previously, TYRE held a market share of approximately 45% pre-pandemic. TYRE's market share has since expanded to 60% of the domestic market following the import restrictions imposed in April 2020. Although the import restrictions were lifted in December 2020, importers continue to be challenged by the US dollar shortage, difficulties faced in opening LCs, and significantly higher freight costs. Considering the challenges faced by the importers and the recent capacity enhancement, adding an additional 10% to production, TYRE is well placed to capture a larger portion of the domestic market. Revenue contribution to the domestic market increased from 77.36% in financial year 19 to 92.83% in the second quarter of financial year 22, with the company steadily increasing their market share. TYRE exports its products to 16 countries in South Asia, Middle East, Africa, and the Far East, and hopes to grow this segment once the planned capacity enhancements are in place in financial year 24. The company has an island-wide dealer network of 400 outlets, providing them with a significant distribution reach. The dealers are non-exclusive and house multiple tyre brands. However, the company has built a strong relationship with them over the years and has been successful in ensuring their products are prioritized and sold by offering attractive incentive schemes and credit terms. CEAT is considered to be the most preferred brand among the dealers. The company is the market leader across all segments, including the truck, light truck, three-wheeler, and agriculture tires. The chart reflects the market share held by TYRE across each segment. The company dominates the truck segment with 84% market share in light truck segment and 80% market share in trucks. It also has 72% market share in agriculture vehicles and 51% in three-wheelers. In the high-margin car radials, the company has been steadily growing its market share over the last 2 years and presently holds 48% market share. TYRE also has approximately 36% market share in the motorcycle segment. Following Sri Lanka's vehicle import ban since April 2020, new vehicle registrations dropped 85.4% year-on-year to just 28,434. And in value terms, personal vehicle imports dropped by 95.9% year-on-year in January to October 2021. Restrictions on tyre imports, initially imposed in April 2020, were partially relaxed in September 2020 and lifted in December 2020. Market dynamics changed significantly, where tyres' market share expanded during the period where the import ban was imposed due to a successful customer acquisition strategy. The company has since been successful in retaining their customers even post-removal of the import ban. Despite the relaxation of import controls, the importers continue to face challenges considering the high freight costs, shortage of US dollars in the market, and the difficulty in opening LCs with commercial banks. Some imported brands, including MRF, Michelin, and Bridgestone, pulled out of Sri Lanka following the continuous challenges faced by importers. Draw your attention to the pie chart that reflects the market share of TYRE pre- and post-pandemic. As discussed previously, TYRE's market share expanded from 45% to 60% during the post-pandemic period. Market dynamics have changed significantly post-pandemic. Sri Lanka's current requirement of tyres is approximately 2,400 metric tons per month. Importers held sufficient stocks during the period where imports were restricted. However, locals relied on CEAT for specific categories such as the trucks and commercial tyre range, where imported products are priced at 30 to 40% higher. They continue to prefer CEAT even after import restrictions were relaxed due to the lower cost per kilometer compared to other expensive imported products, and the high quality of the product, which is considered to be on par with imported Indian tyres. Capacity enhancement of over 10% was added in the last 3 months. New products such as high-margin car radials were introduced for popular WagonR and Maruti Alto vehicles, which will help in further driving profitability. An investment of 2.5 billion rupees is in the pipeline to expand car radial tyre capacity and upgrade quality across all segments. The capacity enhancement is expected to be in place in financial year 24. Let's take a few minutes to better understand the industry dynamics and other players in the market. Draw your attention to the pie chart. This reflects the current estimated market share of key players, including the importers. As TYRE controls 60% of the market, the balance 40% is held by importers. Among the importers, 3 players dominate that segment. These include Wheels Silverstock, which is owned by the parent company of TYRE, Douglas & Sons, and Tyre House. Each of these players have approximately 10 to 12% of the market share, with other smaller players collectively holding 7%. Wheel Silverstock distributes tire brands including Nankang, Cooper, Goodride, and Westlake. Global market-leading brands represented by smaller players are estimated to hold significantly lower market share. The market faced a further shift in 2021, where some imported brands, including Michelin and Bridgestone, discontinued operations in Sri Lanka following the continuous challenges faced by importers. Considering the current market dynamics, the threat from new entrants is expected to be limited. However, it must be noted that Ferentino Tyre Corporation commenced operations at their factory in Horana in January 2021 with an investment of $250 million. Ferentino operates in similar product segments. However, the company mainly targets the imported tire market and operates in the higher price segment. The Chinese tire manufacturer Shandong Haohua Tire Company Limited announced its plans to invest $300 million in the Hambantota port in October 2019. However, operations have not yet commenced. CEAT Kalani Holdings' technological partnership with CEAT India provides the company access to research and development. This enables their product to be of higher quality in comparison to other local manufacturers, giving them an edge over the competitors. This has been a key contributing factor in assisting TYRE to grow its market share. I will now hand over to Hasita to discuss the future growth plans of the company, financial forecasts, and valuations.
Good evening, everyone. Thanks, Divya, for the detailed presentation. Following the tire import ban by the government to conserve foreign exchange, TYRE strengthened its domestic production in specific tire categories and sizes based on market demand. TYRE has planned an investment of LKR 2.5 billion over financial year 24 to increase passenger car radial capacity and technological enhancements to upgrade quality across all operational segments. The expansion is expected to result in increasing production capacity in the high-margin car radial segment for brands with high demand, such as Maruti Altos and Wagonars. The car tire market is currently 100,000 pieces per month. TYRE's market share in this segment pre-pandemic was around 30%, with imported tires catering to 70% of the market. The company increased car radial tire production during the last 3 months, with capacity increasing from 35,000 pieces to 51,000 pieces, thereby expanding its market share to 50%. Following the new investment plan in financial year 24, production in this segment is expected to increase by 50%, in turn capturing further market share. The new investment also upgrades the quality of the entire production process to a higher platform, which is expected to result in higher speed and load ratings. The speed ratings following the upgrades in the production process is expected to increase to handle speeds of 150 to 160 kilometers per hour from the current speed rating of 100 to 110 kilometers per hour. Following this upgrade, CEAT Kalani Holdings plans to benchmark its tires against Indonesian, Taiwanese, and Korean tires. This could result in opportunities to cater to prominent global markets, including Europe. It is important to note, car radial tires generate significantly higher gross profit margins in comparison to truck and bus tires, and is expected to increase gross profit margins across the company in the future. CEAT Kalani's JV production increased 19.97% year-on-year in financial year 21 and 17.5% year-on-year from 1Q to 3Q financial year 2022. This was led by increasing demand from local customers in the truck segment and increasing production capacity of the high-margin car radial segments during the last 3 months. The current production amounts to 1,800 metric tons per month and is dominated by trucks, buses, cars, vans, and SUV segments. The 17.5% year-on-year increase in production volumes achieved in the first 9 months of FY22 was despite production being hampered in the first half of financial year 2022 due to COVID and distribution affecting distribution and sales due to the nationwide lockdowns. The truck and bus segment is the biggest contributor to revenue, accounting for 61% of production capacity. SIAT enters into 1-year forward contracts with the Ceylon Transport Board for bus tires and 3-month term contracts with the Sri Lankan Army for truck tires. With the raw material prices and freight costs increasing much higher than initially budgeted, the bus and truck segment profitability is significantly lower compared to a year-on-year basis. We can expect GP margins to bounce back for the truck and bus segments when the term contracts expire and are retendered in financial year 23. SIAT's revenue CAGR was broadly flat in financial year 16 to financial year 20. Revenue grew 24.94% year-on-year in financial year 21 and 42.5% year-on-year in 1Q to 3Q financial year 2022. The share of domestic sales increased from 83.92% in financial year 17 to 86% in financial year 20 and 94.96% of total revenue by third quarter FY22, led by the import ban in FY21 and customer retention after the import ban on tires was lifted. SIAT's revenue grew 42.5% year-on-year to LKR 11.85 billion in the first 3 quarters of financial year 2022. This was mainly led by higher volumes due to local customers continuing to purchase SIAT tires after the removal of the import ban. SIAT is a market leader with the recent expansion in production capacity. Given its significant market share and the significant increase in raw material prices as well as increases in freight prices, the first average selling price increase was implemented in January 2021. Following that increase, further ASP increases were implemented in 1Q FY22 and 2Q FY22. Moreover, selling prices are expected to increase further on the 1st of March 2022 to ensure gross profit margins are sustained above 25%. We expect revenue growth of 41.33% year-on-year in financial year 2022 to LKR 16.7 billion and 16.23% year-on-year growth in financial year 23 to 19.4 billion. This is backed by the current market dynamics, including reduction in importers' market share and the impact of a full year's uninterrupted production of the expanded production capacity. Synthetic rubber is manufactured from processed crude oil. The average crude oil prices increased 93.12% year-on-year in April to November 2021. In addition, natural rubber prices in the local rubber auctions continuously increased during 1Q to 3Q FY22. Furthermore, freight prices continued to increase in 1Q to 3Q FY2022, putting additional pressure on cost of sales and gross profit margins. Gross profit margins for SIAT was only 21.65% in 1Q FY22 as production was curtailed due to COVID outbreaks and the production facility GP margins increased to 24.68% in 3Q FY22. As a result of the high contribution from the high margin car radial segment, GP margins were still lower on a year-on-year basis as the fixed price term contracts in the truck and bus segments cannot be repriced until the contracts expire at the end of FY22. The company also expects cost savings of approximately 100 million per year through the ongoing process of fitting its factory roof with solar power panels with an investment of LKR 300 million. Considering the gradual increase in car radial tire production and planned selling price increases in 4QFY22, we expect gross profit margins to average at 23.59% in FY22 and a conservative 25% in FY23. It is important to note that the demand for tires is cyclical, where 2Q to 4Q are historically the best 2Q and 4Q are historically the best performing quarters for the company. Demand for agriculture tires depends on harvesting periods, and demand for tires in general picks up during the dry season when road temperatures rise, resulting in more wear and tear of tires. Tire demand for distributors too is seasonal, with demand peaking in 4Q in order to meet targets and incentives prior to the end of the financial year. CEAT Kalani's JV's EBIT increased 17.92% year-on-year to LKR 2.12 billion in FY21, led by the increase in gross profit margins from 25.15 in FY20 to 29.91 in FY21. The EBIT margin expansion was led by decrease in administration and distribution costs as a percentage of revenue from 13.92% in FY20 to 12.22% in FY21. EBIT increased 1.69% year-on-year in 1Q to 3Q FY22 to LKR 1.64 billion. However, EBIT margins increased to 15.43% in 3Q FY22 from 12.83% in 2Q FY22, in comparison to 22.23% in 3Q FY21, which was mainly led by the drop in gross profit margins on a year-on-year basis. Operating costs were managed effectively in the third quarter FY22, where administration and distribution costs as a percentage of revenue recorded at 9.13% versus 10.3% in 3Q FY21. We expect administration and distribution costs as a percentage of revenue to be 9.17 in FY22 and 9.25 in FY23. Considering the expected increase in gross profit margins in FY23, EBIT margins are expected to conservatively improve to 15.65% in FY23 compared to 15.43% in 3Q FY22. As explained previously, net earnings of CEAT Kalani joint venture is expected to decrease 5.08% in FY22 to LKR 1.85 billion due to the production disruptions with multiple COVID outbreaks in the first quarter of FY22, sales disruptions due to the nationwide lockdowns in the first half of FY22, lower GP margins on bus and truck term contracts due to high raw material and freight costs, and lastly, higher deferred tax charges applicable in financial year 2022. Recurring net earnings in FY23 is expected to increase by 40.18% to LKR 2.59 billion due to higher gross profit margins across segments, higher contribution from the expanded capacity in the car radial segment, and the bus and truck GP margins getting adjusted with the expiry of the current term contracts. Recurring net earnings of CEAT Kalani Holdings increased 108.63% year-on-year to LKR 1.98 billion in FY21 due to strong revenue growth of 24.94% year-on-year, with production increasing to 17,612 metric tons. Gross margin expansion of 476 basis points year-on-year also supported net earnings in FY21. Although CEAT Kalani Holdings EBIT is expected to increase by 13.4% year-on-year to LKR 2.4 billion in FY22, the JV's net earnings is forecasted to decline 5.08% in FY22 to LKR 1.85 billion. As a result, TYRE's net earnings is expected to decline 9.81% to LKR 826.5 million in FY22. TYRE's net earnings for FY23 is forecasted to increase 43.8% to LKR 1.19 billion, mainly due to the expected gradual increase in gross profit margins as a result of the higher average selling prices and the impact of a full year's uninterrupted production after the completed expansion in production. Given the forecasted 43.8% increase in TYRE's net earnings to equity holders in FY23, the stock is currently attractively priced at 7.19 times FY23 earnings. Given the 50% dividend payout ratio, the dividend yield in FY23 is forecasted at an attractive 6.96%. As explained previously, CEAT Kalani is well positioned to cater to local demand against the backdrop of importers' market share, reducing with the current shortage of foreign exchange and higher freight costs. CEAT's market-leading position enables the company to increase average selling prices to cover cost escalations. An additional increase in ASPs is expected on the 1st of March 2022, which will drive GP margins in 4QFY22 and FY23. The company is expected to embark on a LKR 2.5 billion capacity expansion in the high-margin car radial tire segments in financial year 24. This expansion has been ignored in our forecast. TYRE currently trades at a 10.34 times on FY22 earnings and 7.19 times on FY23 net earnings, with an attractive dividend yield of 6.96% forecasted in FY23. Although the market PE ratio is presently 14.2 times, we assign a conservative PER of 10 based on FY23 net earnings. This results in a fair value of LKR 147 rupees and 75 cents with an upside of 39.06% based on FY23 earnings.
Mr. Divya and the research division for our valuable insights. Now, Mr. Shehan Mendes, Director of Capital Trust Securities, will read out some of the questions that are relevant to many clients which have been sent through the chat by the audience.
Good evening, ladies and gentlemen. We warmly welcome you to another research webinar by Capital Trust. Thank you, Divya. Thank you, Hasta, for the presentation. So I would like to now open up the floor for any questions you may have. There's one question which have already come in by Mr. BK. The question is on ACL. ACL Plastic is providing the insulation cover and PVC for the cable production. So could we expect the same demand as ACL cables for ACL Plastics? Does ACL Plastic import the raw material or use the local rubber?
Let me just take that question. So I think ACL Plastic does import, I think it's PVC resins that's used to manufacture various products required. And our assumption is across the subsidiaries, demand to increase in line with our revenue growth figures, as well as the earnings, the contributions in terms of percentages for the subsidiaries, Kalani Cables and ACL Plastics and ACL Group to remain similar to what was reported historically. So with the earnings revisions, we expect those subsidiaries also to perform accordingly.
There's a question on Kalani Tires. Of course, this is the first time that we are covering Kalani Tires. So this question is by Nadun Jakodi. What is the reason Tyre shows a loss in this quarter?
So you look at the company level. So how the group is structured is majority of its profits comes through the Kalani CEAT Kalani JV, which doesn't come. It comes through equity holders contributions because they're a joint venture of sorts. So it's not, you shouldn't really look at the company level performance, because it's just a various properties and rental income that's held at a company level. And then the rest of the profits comes through JV. So if you look at the JV, it's not a loss-making operation, as we said. They did report, I think, 350 million or something along those lines in terms of profitability for the quarter. And we are forecasting 860 million profits for FY22, and then around a 40% growth in FY23 to arrive at around 1.1 billion.
There's another question by Shanaka Daluvatta. The question is, what is the reason for giving a very high fair value for ACL cables?
So Shahan, actually, in terms of the company's performance, I think when you look at it, if in the last, between November 2020 to October 2021, there's been 5 price revisions, increasing the average selling price by about 50%. So that should also positively contribute to the GP margins. In addition to that, there's a capacity enhancement that has come in the 3rd quarter, because they acquired the machinery, they acquired and modernized machinery of another major player that is no longer operating. So that enhanced capacity will help them increase their dealer market capacity by another 50%. So we have factored all of these into consideration and arrived at a higher revenue figure, considering the higher ASPs, the higher demand in the 3rd and 4th quarter, which is generally in line with the construction and building material space. Generally, there's a cyclical demand element. So 3rd and 4th quarter should be much higher as well. And the ability for the company to further strengthen the GP. Because if you look at it in the 1st quarter, actually the GP was 16, 2nd quarter was about 21. So we have conservatively assumed that it will be around 20 for the next 2 quarters. So the year will average at about 19.8 and next year about 19.1. So considering all of this, there is a significant increase in the earnings expectation. So in line with the earnings expectation, we haven't changed our valuation methodology. That's very similar to our previous webinar that we held. So we believe that the company should trade at a PER of 11 times, given that it's a dominant player in the market and a price maker, because they have over 70 to 75% market share. 11 times is a significant discount actually to the broader market of 14.2, as well as a significant discount to the other peers like Sierra, which is at about 17.35, I think.
There's another question. What will be the impact of recycled or reused tires in two tire? Because most middle income riders are opting for cut tires, as far as I know.
Just on demand side, as Divya mentioned in the presentation, I think the demand is around 2,000 metric tons, 1,800 metric tons a month. So across different segments, obviously demand varies, and as I mentioned before, it is cyclical to some extent, where the 2nd and 4th quarter is where sales increase significantly. But in terms of, I think what speed ratings and load factors are quite important. Yes, there will be certain people that use recyclable tires, but in terms of safety, most, I think, consumers will opt for new tires when they wear off. So in terms of demand, there has not been a reduction in demand across different product ranges. But as we said, because of the Forex crisis faced in the country, and the smaller importers have difficulty in importing certain brands. For that reason, CEAT's market share is increasing, and it's eating into the importers' market share. I think there was a slide covering that where market share increased from 35 to around 60% post-pandemic and lifting of the import ban. So we don't expect a significant impact coming from the reusable iron reuse tire market or recycled tire market.
And just to add to that, actually, during the import restrictions, during that period, there were sort of locals did rely on CEAT, and they started even trying out CEAT for even the other segments, and they were happy with the quality as well. So that coupled with the issues like Hasita mentioned faced by importers is giving CEAT an edge, and they have steadily grown their market share to about 60% at the moment. So I think out of maybe a total market of about 2,400 metric tons a month, they supply about anywhere between 1,600 to 1,800 metric tons a month.
Just adding to that as well, in terms of the car radius segment, which is the more profitable segment, there's just increased capacity by around 10% as well. And since CEAT has a price advantage compared to the importers, we can expect them to increase market share in that car radius segment as well going forward.
There are some general questions also, few concerns that investors have. This is with regard to the interest rates, especially the policy rates were increased recently. The question is, what will happen to capital markets if there is a further increase in interest rates?
Shahan, I think the general questions, it might be best to have Tushan's view on things as well.
Sure.
So we'd like to call Tushan, if possible, to come and answer some of the questions from the audience. I'm sure they'll be interested in hearing from him.
Just give us 1 minute for that.
Yes, Shahan.
Thank you, Tushan, for joining with us.
Yeah, Shahan, please give me some notice. I was not ready today to talk, but let's see.
Yeah, I think it's worthwhile, definitely worthwhile getting your opinion also in some of the general questions we are getting. I'll just read out one of the questions which came in just now from Mr. Nisan Karachige. The question is, what will happen to capital markets if there is a further increase in interest rates?
Well, we have been repeatedly sending out WhatsApp messages and educating the investors. So let me once and for all give a comprehensive reply for this. Now, the Monetary Board on 20th January 2022 increased the standing deposit facility rate by 0.5% to 5.5%. And the standing lending rate facility rate by 0.5% to 6.5% at the last policy meeting. This will result obviously in a marginal increase, and that marginal increase of interest rates would be about 0.5%. And then we must keep in mind that however the interest rates are going up at the rate of 0.5%, the inflation is rising much faster. Now, if you take the Colombo Consumers Price Index headline inflation, it reached a high of 12.1% in December 2021, and the food inflation increased to 22.1%. And I'm sure the coming months, these two figures will be higher. And also, if you all are involved in renovating your house or doing a major construction, you will realize that the construction material have gone up more than 50%. In other words, today and the previous webinar, you understood that ACL cables have increased their prices in the last 1 year by over 50%. So then if you go to the supermarket, also you will see what the actual inflation is. It's much bigger amounts. So therefore, the market rate of inflation is very much higher. And we expect the inflation to continue to rise in the short term, especially not because of a fault of this government. It's stemming from all countries have done money printing, and there is a tremendous rise in commodity prices. Commodity prices world over have increased by more than 100%. And in Sri Lanka, due to 3 years of tourism not being there, there is very high inflation. Then coming back to the other side, you get average weighted fixed deposit rates that has marginally increased from about 5.7% to 6% presently. Therefore, the net interest rate after tax of 18%, because if you are an individual, not like earlier, there is no withholding tax, you have to pay 18% tax on at your income tax return stage on 30th November. And so the net interest rate after tax is only 5%. So considering the official interest inflation of 12.1, this results in a negative real return of over 7%. But as I told you, if you take inflation at a much higher rate, which I don't want to tell here, but you think what the inflation rate is minus the net interest after tax of 5%, that is the negative real return you get from investing in fixed deposits. So then further, I must tell you that customary worldwide, when interest rates go up, there is a flight to safety of funds. But in Sri Lanka, there is no such thing. There is no foreign funds selling now. And there is no EPF investing or selling. Then there is no private provident funds. There is no other insurance companies other than Sri Lanka Insurance. As far as I know, they were also rather quiet in the last 1.5 months. So there is no, fixed income type major companies also going to shift because there is a 0.5% rise. Even if there is, we'll say every quarter 0.5%, and there is a total of, we'll say even 2%. Still, fixed deposit holders won't be foolish enough to go out of their profit-making recommended stocks, which are given more than 300%, just because they are getting 2% more in fixed deposits, right? So far, officially, it's only 0.5%. So it's a myth, and it is something which the sabotagers of the stock market for political reasons who bring that the interest rates are going up and it's bad for the capital markets, and those who want to put down certain shares to buy them only are shouting about these interest rates. There is no relevance whatsoever of interest rates of 0.5% or 2% at the moment.
Thank you, Tushan. That was a very comprehensive answer on the matter. There's another question. This is with regard to going to IMF. We saw there were some remarks made on newspapers also. What will happen to capital markets if the government goes to IMF for a bailout package?
Generally, IMF programs worldwide bring about macroeconomic and structural reforms. Then IMF looks at macroeconomic variables, things like monetary and credit aggregates, international reserves, fiscal balances, external borrowings. And so they have a set of things they look, and certain prescriptions they give. Then, okay, we'll say, although the government is saying it's not going, at some point it is forced to go. So then, I mean, we have tailor-made our, solutions for that. So then what happens is, IMF comes in, they will depreciate the currency to make exports more competitive and overall improve the balance of payments. Then again, the dollar income and dollar asset companies will tremendously benefit. Now what has happened is the dollar income companies like Expo, D Products, TJL, Haley's Advantage, those companies, they have to do their financial statements of September 30th and December 31st, 2021 at a ridiculous rate of 203, where you cannot buy dollars at that rate from any bank in Sri Lanka. So what will happen is if IMF comes, they will take it to equilibrium level. So at the moment, mass scale business is done between exporters and importers around 235 to 245. That is opening of LCs. But if you want to transfer, it will be very much higher. So what will happen is when IMF is there, the rupee will be allowed to float a little, and officially in the financial statements, the dollar assets which are shown at 203 will be shown between 235 to 245, I feel. And these will tremendously benefit the, that's exactly what we have been waiting. Then further, it must be noted that the current inflation is a cost-pushed inflation and not caused by a demand pull inflation. So as a result, I don't expect the KIO to be raising interest rates, because that will not effectively control inflation, right? And I have already told in my previous answer that by increasing interest rates 0.5% over 4 quarters or something has no impact whatsoever in the stock market, because negative real returns are very much more. Then other than that, it's very, I mean, there are positive things. I mean, you mustn't show that IMF is a devil, because it will reduce fiscal deficits, which can be brought because of increased and which will bring increased revenue collection through taxes and reduction spendings to, the poor people. Then also IMF will support to negotiate with our creditors and restructure our debt. Therefore, what I would tell is that we have thought of all these eventualities, and we recommend investors to hold on to export-oriented companies and companies with dollar earnings and dollarized assets. Then again, you will tell, if IMF comes, the taxes increase. We have thought about all that in our recommended stocks. So if you take a share like Expo, only 5% is related to Sri Lanka. So even if taxes go up a little bit, it doesn't matter at all, right? And if there is a super gain tax also, it doesn't affect Expo. Then you take the other dollarized asset companies, LOLC and BIL, also 70% of their real estate, 200 billion and 150 billion respectively. You take 70% of that, all that is overseas, that will benefit from the dollar issues. And when you take the income that the respective countries, they get taxed, and because those are held in different subsidiaries. Then so basically what is important is the companies which has overseas subsidiaries don't get affected by the increase in taxes in Sri Lanka. While of course there will be certain set of companies which will get affected from increase of taxes which are not in our recommended list of stocks. Yes, sir.
There's another question on Expo by Madisha. Before that, actually, I have to congratulate Capital Trust Research, especially Divya and Hasita, for forecasting Expo's profit at our last webinar for as 22.2, and finally on Friday the results came, it was 23 billion. So well done for getting the research spot on that. But the question is actually by Madisha. The question is after the results were released, why has the share price have come down? Any idea that you all would like to share, Tushar?
Oh, that's well, it's like this. If you take the US markets, you buy with the rumor and sell with the news, right? That is a standard way how markets have developed. So our market also has developed to that. So when every quarter the investors who have lesser money want to make a quicker buck. So if you go back to history, in the first quarter, Expo recorded a profit after tax of 6.3 billion. And far as I remember, the share price was 67. And I remember certain high net worth individuals phoning and saying, Tushan, we are in trouble because we expected once these staggering results are announced, confirming your research of, I think we told that it's going to make, I think 6.2 or something like that. You know, we thought the share will move up and it's not moving up. What's happening? So basically what I told them was a large number of people have followed our research and also the various WhatsApp groups and overloaded Expo without money. And now the bus is halted and waiting for those who have overloaded without money to get out and go. So I remember the following day, it was around 73 rupees, but still stuck. So then the ones who had not paid had been forced out of all the broking firms. Then the share once again zoomed up. Then I remember when the second quarter results came, I think the stock was around 216 when it came. And again, I remember there was heavy selling, like in, you know, like a terrorist attack. People were selling because they expected about, I mean, whatever they expected, they knew it's going to be more than double and they just wanted to sell. So again, the people who had not bought, not paid, were getting forced sold. People who thought they have made a lot of profit were getting out. And I think the following day it was 210, right? So the price came down after doubling the quarter-on-quarter profits. So again, this time we come and say not 12.1 billion, the company will make 22.2 billion, right? A very high figure. So people buy, and then the results come, they have no holding power, they are selling out. So that is very much accepted. I mean, that's the way how markets work. So then whenever all these get absorbed, like in the last 2 quarters, the share will gain rebate. Because end of the day, you sell, I mean, you know, everyone must understand, you sell and what do? Do you go into 5.7% earning fixed deposits, or do you go into a not that safe finance company at a slightly higher rate? Or looking at the what has happened in the Expo, like every quarter, it has been like last 3 quarters has been 100% quarter-on-quarter growth. And I'm sure that the management is not so dumb that they will show a decline in earnings in the near future. They will also balance out the earnings so that every quarter for the next 10 years will be slightly higher and higher. right? So basically, the company makes a value, creates value addition through acquisitions and increasing volume, so that the Japanese, they think on a very long term, like 10 years, and they are creating a 10-year, a value-added company.
There were some concerns also, Tushan, with regard to we saw some shareholders getting circulated after while the results, we were waiting for the results. We saw some shareholders getting circulated, showing that certain shareholders have sold some of their stakes, and also there was certain analysis done on a credit given to certain shares. So how should someone should look at these information, and how should they digest this information in their decision making?
Right. What are you saying? You're saying, can you?
There were on Expo, we saw some of the shareholder lists were circulated, and it was highlighted that certain shareholders have sold out part of their small portions of their shareholding. So things like that, how should an investor look at these information in their decision making?
Okay, I can't talk for other major shareholders of Expo. I can only talk about Capital Trust Holdings Limited and Capital Trust Properties Private Limited. So which both have been continuously increasing their shareholding in the last 1.5 years, and taking a very long-term view. And everyone can see from shareholder list that we have been continuously buying shares with a very long-term shareholder list, and we do not buy before a webinar and sell thereafter, or we do not just before quarterly results buy and sell thereafter. We do not buy just before a strategic acquisition and sell thereafter. We accumulate as and when we have excess funds where we are comfortable to hold on, and we are confident that the management has a specific vision and they are backed by SG Holdings. Because if you take the people who invest in global markets, they invest in companies like Tesla, etc., in US market. And in Japan, they invest firstly in SG Holdings. Although there is a yen issue, that's why you get the SG Holdings share, like the share price once in a way dipping. That is something to do with the yen and the overall direction in the Japanese market. But it's nothing to do with SG Holdings or the freight rates, right? People have got it completely mixed up. So basically what I have to tell you is, you all have to take a very direct view. When there is no other company which is making 100% quarter-on-quarter growth in the last 3 quarters, and there is no clue whatsoever to say that the future profitability is going to reduce. It's a myth that just people say rates come down, but rates come down, acquisitions happen, then because COVID is going off, volumes increase, the quarter-on-quarter profits, obviously it can't go at the rate of 100%, but it will be gradually increasing. So coming back to shareholder list, basically you all must understand that that when a share goes up very fast, then the margin trading providers have a single borrower limit, single stock limit, and then the shareholder has to take those shares and go to another margin trading provider and then borrow on it for other shares. So in a shareholder list, you will first find a particular quantity, and when you do a private transfer to 1, 2, or 3 other margin trading providers, obviously that quantity reduces. And cunningly, if somebody just takes only 15 names, then what got reduced is you don't see in that list coming back in another thing. So then you need to take the entire 100 or 500 and see where and where they have popped up. At the same time, it is every shareholder's right to sell when something goes up, looking at technical analysis, sell about 5-10%, and when it comes down, you gain buy that 5-10%, and in between you can be in cash or you can go into another stock, make a loss and come back, right? But looking at the main names whom I know personally, all those people try to sell and go into some other stock, do something and come back, but the net result has been a big loss to those people. So whatever said and done, I urge all investors to look at the fundamentals of the company and the business model, whether it's dollarized or not dollarized, whether it's mirroring the Sri Lankan economy or not mirroring the Sri Lankan economy. They have to look at that aspect and not to follow some name in a shareholder list. So in other words, shall I just explain like this? Because when you talk shares, people think shares work one way. No, shares is also asset class. Now we'll take something which you people will understand. During the Yahapalnya period, we'll say there was 5 well-known people who wanted to sell a 2-bedroom on 320 apartment at 42 million, right? So that doesn't mean the rest of the 500 people have to go on selling their apartments. Then a wealthy person next door to my house went and sold his house. That doesn't mean that I should quickly run and sell my house, right? You need to do what is good for you and what is governed in the CFA books, CIMA books about how to invest in shares. You don't follow anybody's Twitter message or shareholder list. That is ridiculous. Then another thing I must tell you is there was a webinar by Expo last Friday, and there one of the sentences what I heard was that they said, the management said, we are very excited about expansions into Europe and Africa. So I feel they won't say that they are excited and not do anything. Obviously, there is something cooking in those places.
Thank you, Dushan. So also with regard, there are some concerns about the amount of credit given to certain shares, concerns saying that the share prices have been fueled by these amounts of credit. What is your take on that?
Well, that's really a foolish question, because far as I remember, up to 30th November 2021, where the central bank results came, I specifically asked our economists at Capital Trust Research, what is the amount all financial institutions have lent? The answer came as 6,420 billion rupees have been lent by all financial institutions, right? So when you take one of the major asset classes against property, financial institutions lends against property, the property is illiquid and the property is in the hands of the borrower. The financial institution can't come and take it. Then if you take leasing, again, they lend up to 85%. The vehicle is with the borrower, and the security can disappear. And also now you can't do leasing because there is no car imports. But if you take margin trading, it's a very lucrative instrument for the financial institutions, where the security is very liquid and it's just in a computer. You can liquidate even 300 million within 2 hours, because our daily average turnover is 5 billion now, and not 300 million as we saw during the Yahapalaya period. Then coming to your question, this actually I don't think anyone has this data on how much is lent against shares, but somebody was telling me it's about 60 billion, right? So 60 billion is less than 1% of the 6,420 billion lent on all asset classes. And in my view, this 60 billion is very, very small. It should be at least 600 billion, because this is the most liquid and safe instrument for financial institutions, right? And what matters is the margin has to be controlled. We can't come and say that Commercial Bank of Ceylon has lent such and such an amount and it is the most risky one. That's an old-fashioned way of thinking. You take Commercial Bank, what matters is they are very conservative in the way that they take 2 or 3 times collateral. That is, they lend up to 33% or 50% when they are giving against property. In the same way, for shares, they are giving 40% or 50%. So what matters is the margin, not the rupee component. People have got it completely mixed up. You need to, everyone has to, I'm repeatedly saying, and I will challenge anybody that when interest rates are high, you have to borrow. At 10-12%, you have to borrow and invest in shares. If you don't, you will get marooned, right? So you need to borrow, and 1% of the total amount lent in financial institutions for margin trading is very, very low. And also, I must also tell you that I have been, 30 years when I started my career, the turnover for a day was like 20 million, the entire stock market. Then Yahapalaya time, 200, 300 million. Now 5 billion. You take Expo, as I remember, how much was the average daily turnover? I think Expo average daily turnover in 2021 was 775 million. Bill was I think 675 million. LOLC I remember was around 300 million a day, right? And RCL was about 120 million a day, right? So these are huge turnovers in Sri Lankan context. So there is no risk in investing these shares because you can get in and get out. That is what creates a proper market where you can get in and get out. So this myth about credit is all wrong, because at the end of the day, it's less than 1% of what all financial institutions have given. And if somebody has not borrowed, I think that is a big mistake. They have to borrow to survive in this abnormal period of high inflation.
There's one final question I'll take up by Hiranya. The question is, I think last 3 days, I think before yesterday, the dollar income and dollar asset shares have come down. What is your view in the coming weeks?
Well, okay. Yeah, I have been hearing this question, concerns over and over again. Let me tell everyone. Well, if you go to study economics in CIMA or Chartered or wherever, like in the first 2 days itself, you're taught the basics of economics. That is, scarcity increases demand and prices. For you all to understand, let me explain. In Sri Lanka, you need to only create a 20% scarcity in rice or sugar or onions or whatever. Then what happens? Price increases 75%. If you create a scarcity of about 95%, and people just want it, right? Then people will just go and pay anything, like even 500% they will go and pay. Then if you please go and talk to a manufacturing company which is adding value and importing, or a company which is importing various electronic gadgets, you will find that it has been very, very difficult to open LCs in the last 3 months. I was told in one of my businesses from 27 December, it was impossible to open LCs, and LCs are only open for essential services. So in my view, there is a 95% scarcity in dollars in the country. Now, if something else is, there is a 95% scarcity, the prices go up even 500%. Now, some fools in the market are saying, when there is a 95% scarcity in dollars, the dollar income shares and dollar asset shares should come down and selling the shares. That is hilarious. That can't happen, right? So if some person wants to jump out of a 30th floor of World Trade Center, they can do it. Nothing will happen. I mean, somebody can just jump out. Somebody can jump out of any share. Somebody can temporarily disrupt a share price. But end of the day, in worldwide textbooks, there is economic theory that will finally, prevail. So dollarized assets cannot go down. So now, for example, when like Expo recorded a 23 billion profit after tax, and that was predicted by Capital Trust Research as 22.2, and Capital Trust Research is always conservative, mostly conservative, most cases. So now Capital Trust Research is forecasting 57 billion for FY22, and in my opinion, that is also conservative, right? And it's up to everyone to wait and see. Then in the same way, if you take the other dollarized companies, the way certain companies are doing, I'm sure that there is at least one company which will make much more profits than Expo. Then the other sector we are talking is the tile sector companies. But that tile sector companies, you take Royal Ceramics in the annual report itself, they are showing that there is a dollar deposit of 605 million, and because of what you call those mosaic tiles exports, that dollar figure I think is more now. So there is no shortage of dollars in the tile sector companies, as well as the Haley's group also has exporting companies. So I'm sure the tile sector companies have absolutely no problem in importing raw materials, and they also have no problem at all. So I think I covered everything well.
Yeah. So with that, we would like to wind up the Q&A session. Thank you, Sushant, for joining us in short notice. And thank you, Hasita. Thank you, Divya, for for the lovely presentations on Calny Tyre and ACL cables. We thought of, apart from the specific questions on the company, we thought of taking up some of these other concerns that you all also have. So hope that that was very informative to everyone. So thank you very much for joining with us this evening. Thank you. Over to you, Prashani.
Since there are no further questions, I would now like to close the webinar. We want to keep our webinars concise and relevant, but we assure you we will be back soon. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our staff who helped to organize this webinar, and for our valued clients for their support and continuous trust in us. Thank you very much. Have a nice day.